Good morning, everyone. This is so early, but welcome to this special live stream with the release of the Consumer Price Index, or CPI, data for the month of January 2023. So it is set to be released at 5:30 a.m. or 8:30 a.m. Eastern Standard Time, and we're getting a big update for the month of January in about 7 minutes or 6 minutes here. And inflation for the month of December rose 6.5% year over year, which decreased by 0.6% from 7.1% before the seasonal adjustment. Some economists like FactSet are projecting the CPI to rise 0.5% for the month, and which would be its biggest increase since October. And the core CPI is also expected to rise by 0.3%, which shows a slight improvement from December's reading. But the CPI projection year over year is forecast to rise 6.2% in January versus 6.5% in December, and core CPI to rise 5.5% versus 5.7% in December. Cleveland Fed's inflation nowcast is projecting the CPI to rise 0.6% month over month, or 6.5% year over year in January. For core CPI, the tracker is estimating 0.5% month over month and 5.6% year over year. And most economists are concerned about the core services prices accelerating again, because that would signal the Fed to possibly raise more interest rates. And Jerome Powell, in his last speech, indicated signs of disinflation, or what he called the beginning of the disinflation process. And the Fed raised interest rates by 25 basis points. And we saw some incredible market returns for the month of January. And the summary of economic projections that was released back in December 2022 showed a real GDP projection at 0.5% for the year 2023. And the unemployment rate projection is 4.6%. The PCE inflation projection increased from 2.8% to 3.1%, and the core. Let me see here. Yeah, the core PCE projection inflation is now projected at 3.5%, and we're going to get the next summary of economic projections at the next FOMC meeting, and which will be on March 21st. And we're going to get one more CPI reading in March for the February CPI. And I'm expecting to go live for that as well. So make sure to subscribe if you haven't done that already. And the Fed has indicated their, oh man, there we go. Yeah, and the Fed has indicated their moves in March and May FOMC meetings that they're looking to raise interest rates by 25 basis points. And if we get a worse than expected CPI report today, then I wouldn't be surprised if the Fed becomes even more hawkish in the March FOMC meeting. And the stock market right now is pretty much priced in with the 25 basis points. So if we see a 50 basis point hike in the future, then we could potentially see a slight downturn in the market. And we should see a range of 5 to 5.25% Fed funds rate by the end of the May FOMC meeting until probably November 2023. Now, there are others who expect the Fed funds rate to lower to 4.75% to 5% starting in September or Q3 of 2023. It's really going to depend on the CPI reports going forward, and specifically in the car industry and the housing market, because those have the biggest indicators in the CPI reading. And I want you to be aware of the headline that might tell you, how bad inflation is based on the year over year numbers. The reason why I'm doing this live stream on the CPI reading is that I want you to read the CPI report yourself to understand the current state of the economy and future projections. And how does this CPI calculate the cost of living? And how does it change our purchasing power, right? And the CPI tells us one of the most important indicators of the economic condition. And take a look at the 20-year chart here, right? So we started seeing an increase in inflation back in April 2021 at about 4.2%, whenever I get there. And that's when I started making financial videos on my YouTube channel. And it wasn't until like about October-ish around that time frame, when the mainstream media started picking up, when the CPI showed 6.2% year over year increase, and we reached a peak at 9.1% in June 2022, and the stock market really started selling off in March or April of 2022. And when the country shut down back in March and April of 2020, we saw very near deflationary statistics because people stopped spending money, and we went through a very short-term recession. We go all the way back to 2008, 2009, global financial crisis, we saw a decrease of 2.1% due to high unemployment and a year-long recession. And several economists are predicting the same pattern that we saw back in 2009, that we could see a deflationary period. And I don't necessarily agree with that prediction because American consumers are still spending money in several sectors like the travel and service industries. So, in my opinion, if we see a headline between 6% and 6.2%, we're going to see a big surge in stock prices when the market opens in an hour. The expectation is at 6.2%, while core inflation is expected to be at 5.5%, and that is the bullish case. If the CPI headline says anything above 6.4%, then I could see some sales happening when the market opens today. We'll see. But let's go ahead and take a look at the release of the CPI report. Let's take a look here. Okay, so we got a January consumer prices increase 0.5%, estimated 0.5%. Let's take a look here while I pull up the report. But what I'm going to do, I'm going to show you guys Bloomberg.
That may have affected this. So we'll go through the numbers and see what the actual changes are. The one thing I can tell you, because you asked me, John, was gasoline was up 2.4% in the month of January, and so energy prices there did make a difference. Natural gas prices were up 6.7%. That had been a weaker area, but with the cold weather, come up a bit.
Mike, you keep breaking this down. I'll just break down the price section. We were positive. We're now slightly negative by not even 1/10 of 1% on the S&P 500. Yields were lower on the session, then they flipped positive. So they were down about 2 basis points. We're now up about 2 or 3 on a 2-year to 454 again. 455 was the high of the session yesterday. So we're kind of back to those levels again. Up about 2 or 3 basis points through the front end of the curve into the belly onto the 10-year, up about a single basis point to 372-ish. These aren't major moves relative to where we have been. But Lisa, the data is something we'll continue to chew over in the coming hours and the coming days, no doubt.
This is significant, especially on the heels. Yes, it was bang in line with the survey. However, the revisions that were upward for the prior month.
All right, so we got the consumer price index. Right now we are looking at, there we go. Okay, so consumer price index for all urban consumers rose 0.5%. I'm going to go ahead and move myself over here so you guys can see it a little better. Rose 0.5% in January on a seasonally adjusted basis after increasing 0.1% in December. Over the last 12 months, increased 6.4% before seasonal adjustment. So it's not good, is what I'm reading right now. So it did increase as expected. So again, the forecast was 6.2%. Now it's increased to 6.4 or 6.5 from last month, year over year. The index for shelter was by far the largest contributor to the monthly all items increase, accounting for nearly half the monthly all items increase. With the indexes for food, gasoline, and natural gas also contributing, the food index increased 0.5% over the month, with the food at home index rising 0.4%. Energy index increased 2% over the month. Okay. Did not see that coming. The index for all items less food and energy rose 0.4% in January. Okay, so included shelter, motor vehicles. Yeah, so looks like energy went up by 2%. And we're going to take a look at what's going on with food here. Yep, see some pretty significant increases. So I want to make sure that you guys can see it okay. So food for this is 0.5%, food away from home, 0.4%. Yeah, the energy is 2%. Wow. Okay. So gasoline going back up 2.4%. Fuel oil went down negative 1.2%. Electricity, utility. And this is what I was kind of paying attention to as well. The used cars and trucks right now, this is showing that negative 2% and negative 1.9%. And then the used cars have increased again to 0.2%. Still one of the biggest indicators here. But the medical services, medical care keeps going up as well, 1.1%. Shelter at 0.7%, and transportation services going up by 0.9%. Okay, so that was the medical care commodities going up by 1.1%, and the medical care services went down by negative 0.7%, which is really interesting. But the transportation is year over year, it's up 14.6%. Shelter is up. Used cars and trucks going down, which is good news. That's something that I was concerned about. And just looking at the gasoline, the energy prices definitely have gone up again for the month of January. So we'll see what happens. If I had to guess on what's going to happen, and I'm going to read through this more in detail, but the Fed is going to be looking at this and say, okay, maybe we need to do more, increase interest rates. Let me know in the comment section down below what your thoughts are to get to their target rate at 2%. But the food index, we've all seen the memes about eggs, right? I'm in Vegas, and the egg prices were ridiculous. And my wife went to Costco last weekend, and she finally got some eggs. And for several weeks, we couldn't find them. They were just out. And it was just crazy. It was like a dozen of eggs for $12.99 or $13.99 or something like that. It's just insane. But just the food index going up by 0.5%. And I'm really wondering how it's going to be for the month of February. Fruits and vegetables index fell 0.5%. That's good. I need to tell my daughter to eat more vegetables. Let's see. So the energy index rose 2% in January as the gasoline index increased 2.4% over the month. The index for natural gas rose 6.7% over the month, and the index for electricity increased 0.5%. And this is one of the things that I would think is, during winter months, people are using more, right? So the demand is up. With the demand increase, and I think that's probably one of the biggest contributors. And food and energy rose 0.4%. So the shelter index was the dominant factor in the monthly increase in the index, while all other components were a mix of increases and declines. Among the other indexes that rose in January was the index for motor vehicle insurance, which increased 1.4% over the month, while the index for recreation rose 0.5%, and the index for apparel increased 0.8%. Wow. Okay. Yeah. So it's not good, and it's not a good report. Very disappointing. Just kind of makes me wonder how it's going to be going forward, especially in February. We still have one more CPI reading next month. It's actually a week before the FOMC meeting. The next FOMC meeting is on March 21st, 22nd. I think it could be 20th or 21st. But a week prior to that is the CPI report that comes out for the month of February. So it's going to be very interesting to see how the Fed is going to react based on the 2 months of CPI readings. So we got the January data now. It's not looking good. It's at 6.4%. I'm going to remove that banner so you guys don't get confused. So 6.4% is what we got. Anyway, yeah, let's take a look at how the stock market is reacting right now.
Process that is too slow for comfort.
Yeah, well, I think, the markets and the Fed have not quite been on the same page for a while now. The markets have, embraced slower inflation late last year. The markets want a quick Fed pivot later this year. And the Fed has been trying to push back against that to no avail. I thought, Chairman Powell had a nice chance to really kind of, push back at the FOMC meeting when he was asked about financial conditions, and he didn't. So I think the Fed has taken the tack of we'll let the data, determine how the markets react, and we think the data are going to play out in a way that will get things closer to where we think they should be.
Yeah.
It's always a dangerous game when the Fed tries to influence asset prices.
It's a dangerous game when they try to influence asset prices, and yet traditionally this was one of their main transmission mechanisms of monetary policy. How much do they get further away from their goal as financial conditions, by most measures, ease substantially to some of the lowest levels going back, some of the most accommodative levels going back to early 2022?
Yeah, and there's no doubt. I mean, as the minute the markets sniff, that the Fed might not have to go quite as much, financial conditions ease. So in some ways, it kind of it's a self-equilibrating process. But from the Fed's perspective, the concern is that even if you get somewhat weak real economic data, inflation might prove sticky or stubborn.
Yeah.
And that's the scenario that the market really hasn't been willing to contemplate much.
Stephen Stanley, thank you so much with Santander this morning. Diving into the data, Michael McKee here. Is it this time is different, as Rogan would say?
This time is better. I mean, I can give you a good reason if you want to be optimistic now.
Please.
And we can all go home and forget about the Fed because inflation is licked. The Supercore, we have the number now. It comes in at 0.27. So 0.3% gain during the month of January. That compares with a 0.4 gain, 0.37 for the month of December. So take out housing. And as Stephen said, you got 40% of that you're whacking out of the CPI. And in terms of the core, and you've got some progress. So we're still seeing some gains.
Come on, isn't this too cute at a certain point?
Oh,
I mean,
sure.
especially if you take a look at some of the aspects, you strip out everything and you get what you want to get. This is massaging the data. And on one level, I understand. On the other level, you've seen some reinflation in areas like used cars. You've seen reinflation in areas, including, a whole host of different metrics. So how do you sort of parse out?
All right. So the stock market is flat at the moment. It was up about 0.5% before the CPI release, but it is just flat at the moment. As soon as the market opens in about 45 minutes, we'll see what happens. But the Dow is actually up pre-market by 0.5%, and the S&P 500 is down about 0.25%. NASDAQ is down about the same at 0.3% pre-market open. So we'll see what happens. I with the 6.4%, just obviously it's not what we wanted to see. We wanted to see the forecast was 6.2% and the core inflation was 5.5%. So, going forward, I think the market is either going to be pretty flat, and we're probably going to see some minimal trades if I had to guess, but we'll see. Just, not a good report. We're going to see what happens for the February one. That's going to come out on March 14th for the next CPI reading. We're not going to have a FOMC meeting until the week after that next CPI reading comes out. So anyway, but just how is this going to impact my investment strategy, right? So that's really something that everyone is worried about, is do we need to change our investment strategies going forward? So, here you go. If you've been following my channel for a while, all the videos I make about the 401k, IRA, TSP, and HSA are all considered long-term investments for those of us working to achieve financial independence and retire early. My long-term retirement investment strategy will always remain the same. I'm always going to max out my retirement contributions every single day until the day I can't. And because when I look at it from the long-term perspective, what the market does in the short term is really irrelevant to me when I'm, in terms of 401k, IRA, HSA. If the market drops another 20% this year or 10% next year, I'm going to continue to buy the same index funds, ETFs, and some individual stocks in my retirement portfolio. And I can't touch my retirement portfolio anyway until I'm 59.5, which is in 25 years. However, if you're close to your retirement age and you're looking to rely on your retirement portfolio to pay for your expenses, then you need to pay closer attention to the market even more to determine your diversification, right? And I encourage you to speak out to a financial professional about your retirement portfolio if you're close to your retirement age. And you can also schedule a free one-on-one 20-minute financial coaching session with me. And you can go to firesidechat.com/coaching to discuss your personal finances. And if you're a veteran, you can schedule 30 minutes instead of 20 minutes. I do specialize in personal finances with veterans as well. But for intermediate investment strategy, I'm going to pay closer attention to the market. I don't do short-term trading. I play some options in the past, and it did me really well back in 2020. I haven't done that since 2021, and I stopped doing it. But that was more of a smaller amount of money that I was like, I'm going to do some options to maybe play around a little bit, learn about it a little bit, but I'm not going to put my entire nest egg into, like call options and put options, right? Contracts. So, but my intermediate investments are something I will use in my early retirement, right? So that's different from the long-term retirement for my 401k, TSP, IRA, and HSA, which is 9 years from now at age 45. That's when I'm looking to retire early. And right now I have a dividend stock portfolio that's going to pay me about 4.5% in annual dividend yield. And I have a growth stock portfolio that's going to appreciate about 8% annually. Hopefully, more than that at 10%, 12%, if I do it right. And I don't necessarily time the market with certain investments like my index funds, but I do time the market with certain individual stocks and sector ETFs based on the current market condition and the earnings reports that come out, right? And what I mean by timing the market is if I see bearish moves on tech stocks or financial sector stocks, right, then I'm going to buy extra shares on those stocks while everyone else is being fearful. And if I see bullish moves in the market, let's say today the market is up, then I'm not going to buy as much shares. I'm not going to put extra money in the market. If I become too heavy in one sector than the other because a certain sector is underperforming, then I'm probably going to buy more of that if I see a potential upside going into 2024, 2025. And if you're really interested in what I'm investing to achieve financial independence and retire early, I encourage you to check out my private membership program to sign up for the private group coaching session that I do twice a month, every other Wednesday. And the next one is going to be next Wednesday, February 22nd at 10 a.m. And you're going to get a free preview of the private group coaching session. But starting in March, those videos are going to be set to members only videos. And today was just a special live stream session for the CPI report. And so I got to take my daughter to school too. So I got to get her up in about 30 minutes. So there won't be any private group coaching sessions until next Wednesday. So anyway, I really wish that we had better news, but we didn't. And hopefully we get a better report coming out next month for the February. So with that said, see you guys.